Welcome to today's session, where we dive into a crucial topic in finance: asset valuation. Understanding how assets are valued is key for investors, entrepreneurs, and business owners alike. Asset valuation determines the true worth of an asset, whether it's tangible like real estate or intangible like patents. Accurate valuation is vital. It affects investments, mergers, financial reporting, and taxation. For investors, knowing the value helps decide whether to buy, hold, or sell an asset. For businesses, it ensures fair negotiations and compliance with financial standards. In essence, asset valuation brings transparency and guides smart decision-making. There are two main types of assets: tangible and intangible. Tangible assets are physical items like land, buildings, and inventory. Intangible assets, on the other hand, include copyrights, patents, and goodwill. Both types play a significant role in an organization's financial health. When it comes to valuation methods, there are three primary approaches. The income approach estimates value based on future income the asset can generate. The market approach compares the asset with similar ones recently sold. The cost approach calculates the replacement cost minus depreciation. Each method has its strengths, and a mix often yields the best results. Several factors influence asset valuation, including market conditions and economic indicators. Challenges like data availability and market dynamics can complicate valuations. That's why professional judgment and current market insights are essential. In summary, asset valuation is about understanding financial health and growth opportunities. Mastering these methods empowers investors and businesses to make informed decisions. For more insights into finance and investment, visit HUMANITYUAPD.com.